My name is Omar Basuony. I'm from the American University in Cairo, and today I'm going to present CO2 emissions and corporate financial performance. This is the evidence from S&P 500 firms. So first, our background and motivation. We have a climate change and environmental sustainability are central to global economic and policy agencies. So firm faces increase in pressure from regulators, investors, and society to reduce their carbon footprint. So by this, we need to understand the financial consequences of environmental actions as it is critical for corporate strategy and investment decisions. So for our research objective, we have three objectives. The first objective is we need to examine the relationship between the CO2 emissions and the financial performance among the S&P 500 firms. And the second question, the key question is, do firms with lower carbon emissions outperform financially? And the last question, how do environmental scores influence both accounting-based and market-based performances? So moving on to our theoretical foundation, we have the RBV. It's sustainable practice as valuable, rare, and inimitable resources that drive competitive advantages. And for the stakeholder theory, responsiveness to environmental concerns enhances legitimacy, reputation, and stakeholders' trust. This will potentially improve access to capital and market opportunities. So for our literature, the positive links we had is several studies showed that proactive environment management correlates with higher profitability and market values, while some evidence showed that the cost of environmental initiatives may reduce short-term profits, though its long-term benefits often materializes. And for the market, investors may reward firms perceived as sustainability leaders, but skepticism remains if environmental actions are seen as superficial. So for our research hypothesis, for our null hypothesis, we had that higher carbon emissions are associated with lower ROA. And for our alternate hypothesis, we had the higher carbon emissions are associated with the lower Tobin's Q. So for our data and samples, we have 500 firms from the S&P, 12,027 firm year observations from 2000 to 2023. Our source is from the Refinitiv data stream, and our industry coverage is broad cross-section, including technology, energy, manufacturing, and services. So for our variables, we have three independent variables: environmental pillar. We only took the environmental pillar from the ESG scores, the emission score, which is the subscore from the environmental pillar, and the CO2 intensity. These are three independents. The dependents are our ROA and Tobin's Q, and the control variables are firm size, leverage, and liquidity. So for our methodology, we used OLS regression model. And as stated, the controls are firm size, leverage, and liquidity to isolate the effect of environmental variables. And also we checked for multi-collinearity between all the variables. So for our descriptive statistics, here are all the variables we have, and we took the minimum, maximum, and standard deviation for each variable. So there is a significant variation in both environmental performance and financial outcomes across the sample. The ROA ranges from minus 150% to 157%, and the Tobin Q is ranging from 0 to 40. So we move on to the correlation analysis. We did the correlation between the independent variables and no multicollinearity was found. But the largest observed correlation was about negative 0.36, which is well within the acceptable limit. Now, moving on to our models. First, we have 6 models. First, we tested for the ROA as the dependent, and then we tested for the Tobin skew as the dependent. And we each dependent has 3 models. We use the environmental pillar as the first model as the first independent, the second model, the emission score, and the third model, the CO2 intensity. These are both for both the ROA and the Tobin skew. So for the ROA, we found there's a strong positive and statistically significant relationship with the ROA. And for the emission score, it had a higher emission scores linked to the higher the ROA. The greater the CO2 intensity, it reduces the ROA. Larger firms tend to have lower ROA. Both leverage and liquidity both positively impact ROA, suggesting financial flexibility. Okay, and this is the 3 models for the Tobin skew, the other dependent variable we have. So for the Tobin skew, we have also a positive and significant association with the Tobin skew for the environmental pillar. And for the emission score, the higher the scores, meaning lower emissions, correspond to higher market valuation. And higher the CO2 intensity is penalized by the market. Firm sizes, the larger the firm sizes, it shows lower Tobin skew. And for leverage and liquidity, both variables support higher market valuation. So to conclude this presentation, we found that robust evidence link lower CO2 emissions and higher environmental scores to superior financial performances. Sustainability is a strategic asset firm that leads in environmental performances and are rewarded in both accounting and market metrics. The integration of ESG into financial analysis is essential for future-ready organizations. So for the strategic implications, environmental leadership is not only ethically desirable, but also financially advantageous. Firms that invest in reducing emissions and improving sustainability scores gain both in profitability and market perception. This is the strategic implementation. For the investor perspective, ESG metrics are increasingly relevant for portfolio construction and risk management, and market rewards firms perceived as proactive environmental stewardship. So for managers, they should integrate sustainability into their core business strategy to drive both financial and reputational gains. For investors, environmental performance as a they should use environmental performance as a screening tool for long-term value. And for policymakers, they should encourage transparent reporting and incentivize emission reduction to align private incentives with public goals. So for our limitations, we should just not focus on the S&P 500 firms and maybe widen our range to a lot of firms. And also not only the 2 financial performance metrics, we should also widen that range also. And for future directions, we should examine other ESG dimensions. We only examine the environmental, so we should look into the social and governance scores as well. And we should assess the long-term versus short-term financial impacts of some sustainability initiatives. And thank you. This was our presentation. Any questions?